Just welcome to this morning's webinar. For those who don't know me, I'm Zoe Roberts. I'm a tax partner at BHP with a particular focus on the property and construction sector. And welcome to this morning's webinar. Just to reassure everybody, it is a webinar for those who are used to doing Zoom calls and Teams calls. Hopefully you can see and hear myself and Andy okay, but we can't see and hear you. So feel free to have your crunching up cornflakes, have your washing machine spinning up its axis, it's fine. If you do have any questions, there is a Q&A function. If you hover sort of at the bottom of the screen, that should come up. Please put any questions that you have as we go through, and we'll try and answer them as we go through. And there will be an opportunity for questions at the end as well. And if you have anything detailed that you particularly want to talk in more depth in, then we're happy to give you a call afterwards. We will be sending out, we're hopefully doing a survey at the end for feedback. Please do stay on and fill that out. It's the first time we've tried that. Doing the survey as part of the end, so the technology may fail us, in which case we'll send you the survey. So again, please do fill that out. So just to give you an idea of what to expect, I'll run through the agenda in a moment as to what we'll be covering. And I first want to introduce Andy Horsfield, who's one of our VAT directors. And Andy will be doing most of the talking after I've just given a bit of background as to why we're doing this webinar now.
Good morning, everyone. Morning, guys.
So the VAT reverse charge changes were initially due to come in a year ago, 1st of October 2019. In fact, I think it was almost a year ago to the day that Andy was preparing to give a very similar seminar on this topic a year ago. It was the morning, I think, that you were preparing to do it, nervously pacing the stage, and the revenue announced that there was going to be a year delay, so that they weren't coming until 1st of October 2020. So I think it changed your seminar slightly, didn't it, Andy?
Yeah, rather unhelpful as usual. Yeah.
And then we've had a further announcement due to COVID, another delay. So these rules now are not due to come in until 1st of March 2021, so 5 months away. It's been delayed twice already. We're assuming the revenue are quite committed to bring this in, but with COVID and Brexit, there is a possibility they might be delayed or changed again. But even despite that, given that these changes have quite a significant potential cash flow impact for certain businesses, and they're due to come in March next year, which is the same month that if you're a business who's took the opportunity to defer your VAT payment due to COVID, again, that will drop in March next year. So potentially there's quite a big cash flow impact from the combined impact of these two. So what we wanted to do was put this webinar on now to make sure that clients and contacts were aware of the changes, the actions needed, and the next steps to sort of keep you in the loop, really. We are planning a follow-up webinar, so that'll be at either the end of the year or early 2021. So as we get more details on these changes, perhaps have a few more sort of practical examples and explanations of the issues that become apparent over time. In addition, by the end of the year, we'll also have had a budget, and there is a consultation into CIS generally, which was started at the start of this year. Initially, they asked for replies by the end of May. That was extended to the end of August, but the implementation date for some of those changes was suggested to be April next year. So again, we're going to hopefully sort of factor that into a webinar later on in the year. So back to this morning's agenda. Andy's going to be covering a bit more on the background of these current VAT changes. We got asked last year when we did these seminars just to do a bit of a refresher on the construction industry scheme generally, because there is a bit of an overlap with the current CIS scheme and the VAT changes that are coming in. And then Andy will go through the VAT changes, the various impacts, who they'll affect, and the next steps needed. So without further ado, I'll hand over to Andy.
Thanks, Zoe. Yeah, so just a bit of background before we get into some of the details. So everyone's aware this is quite a major change for the building and construction sector, and unhelpfully, as Zoe said, the delays and the changes haven't helped, although on the flip side, they have helped a little bit, giving businesses more time to prepare. I know I spoke to a number of you that had joined this morning sort of in the run-up to October last year, and some clients had already started to make changes, systems, and otherwise with suppliers and customers. So I'm hoping there aren't going to be any sort of further implementation delays, given the preparatory work that's needed for this. But with COVID, budget, and everything else, I wouldn't rule it out. So we just have to keep watching that space as we go forward. This is a counter-fraud measure, and I suppose from our perspective, the frustration with that is the then wide implication it has. The idea behind the counter fraud essentially is to stop subcontractors charging VAT and then disappearing before paying that VAT over to HMRC. The challenge there is that it then brings a lot of businesses that have a good compliance record, and there was no risk of them disappearing into the realm of this measure, and sort of all businesses have to sort of get involved with it in this sector. There was quite a lot of noise probably earlier this year in the sector that the fact that HMRC and Treasury had announced this scheme, that it actually already had a sort of deterrent for fraud in the sector. So there was a question as to whether they still needed to implement it, if that makes sense. But HMRC's current view is that it's still needed, and it's still needed as a measure to address some concerns that they have. So the key point, as Zoe said, we're going to do a little bit of a refresher on the CIS scheme generally now, because there is quite a clear crossover in terms of how this works. We'll come on to some of the conditions a bit later, but essentially both customer and supplier need to be VAT registered for this to apply, and those transactions need to be reportable under the CIS. So there's quite a clear link across there. And I suppose just as another background point, probably unhelpfully now, this measure and introduction for March next year also aligns with the deferral periods for VAT that many of you may or may not have taken advantage of under the COVID measures. So any payments that were deferred that were due between March and June of this year are actually due for payment by the end of March next year. So I think having the introduction of this and the deferral payments due could create some additional complexities for clients in this sector that just needs a bit of thinking about, as we move forward to that date. So that's just a little bit of background. I think a lot of you have got an awareness of this anyway, given what we did last year in the run up to the sort of previous dates that this was suggested for. But yeah, just to recap really. So I'll hand back to Zoe for the CIS stuff.
So as Andy said, the revenue have sort of long been concerned about the level of fraud and tax evasion there is in the construction sector. This is a little bit of history. The CIS scheme was initially introduced in 1971. But it was, I think, quite easy to circumvent. Lots of fraudulent certificates circulating, wasn't particularly effective. It was adjusted again in 1999 to include various tests, amongst other things, and it was again amended in 2007 to move to online verification. And as I mentioned, the government still thinks it needs to be improved, partly by these VAT measures, but also with issued a consultation, which again we're expecting to hear back from in the next few months or so. And what I'll do is mention a couple of points from the consultation as we go through. So in principle, the CIS scheme is just a system whereby contractors withhold tax from payments to subcontractors that are made with regard to the construction operations. And the idea is that tax is meant to represent the income tax and national insurance that subcontractors need to pay on their profits. In terms of trying to define who contractors, subcontractors are, contractors are the customers, so these are businesses in the construction sectors who pay subcontractors for construction work. So it can include property developers, which could be at your, so very large house builder end, through to somebody who just buys a small one-terraced house that they're looking to do up and sell on. If you're doing it with the intention to realise a profit, you are a contractor, and potentially anything that you subcontract out will fall within the CIS scheme. If you have gang leaders or agencies who organise and supply labour for construction work, again, they are contractors in CIS. If you're a foreign business, you're not exempt. If you're carrying out construction operations in the UK, within UK territorial waters up to 12 miles, then again, you're in CIS, you're a contractor within the CIS scheme. Householders, they're not within CIS. So somebody who just puts an extension on their home, has a new heating system, they don't have to worry about CIS. You've moved me slide on, Andy. Thank you. I'll forgive you. So in terms of household, they're not in CIS. Property investors and occupiers, so if you're a landlord of properties and you have some work done, then you're not going to be in CIS. If you're a manufacturing company and you have an extension put onto your factory, you're not usually going to be into CIS unless you're a deemed contractor, in which case the construction work you subcontract out is in CIS. Deemed contractors are generally those larger organisations. So this is entities that spend an average of £1 million annually That's looked at over a 3-year period, so it tends to be larger organisations, the property owning ones, so it might be things like universities, NHS trusts, utility companies, railways, those sort of entities who have a large property portfolio. They spend a significant amount of money repairing, refurbishing or constructing. And actually, this is one of the points that we looked at on the consultation as to what the definition of a deemed contractor is. There's a suggestion that will be a slightly different definition, still the same sort of size, but looking at spending, looking at the averaging in a slightly different way. So if you are a contractor or a deemed contractor, there's a few things that you have to do. You must register with the revenue before you pay any subcontractors, and you must verify that subcontractor's payment status before you pay them. And this is the key point of the CIS scheme, and it's one where there can be a penalty of up to £3,000 if, as a contractor, you don't verify that status correctly, or if you apply the wrong rate of withholding tax. You have to give payment slips to subcontractors, you have to submit monthly returns, and of course you have to pay over the tax that you've withheld from the subcontractors to the revenue. And that system's relatively similar to the PAYE system, so it's monthly returns. You have to file by the 19th, pay the tax over by the 22nd, and there can be penalties for late returns as well. And note that some businesses, depending on your supply chains and projects, you can be both contractors and subcontractors. So you might need to register as a contractor and think about withholding, but you might also be suffering withholding tax yourself. So you can move on to the next slide now, Andy. So in terms of what a subcontractor is, this is basically anybody that's agreed to carry out construction operations for a contractor. So it could be either carrying it out yourself, so it could be a self-employed plumber, joiner, brickie, or it could be a larger entity who's agreed to carry out those construction operations, and they use employees or subcontractors. So again, an agency would be a subcontractor, and similarly sort of agencies and gangs where they're providing labour. So if again if the contract with the contractor's contract is with the agency and the worker's contract is with the agency, then it's the agency that is the subcontractor. So as the contractor in that relationship, you would need to verify that subcontractor. At the moment, as a contractor using, say, an agency or a gang leader, you don't necessarily need to be concerned with how that agency is applying their own CIS responsibilities. But again, this is something which the consultation is looking at. There's some early kind of indications of how they might see a proper sort of supply chain due diligence happening, with potentially the main contractor at the top of the supply chain being liable for any CIS errors or omissions that happen further down the chain. So obviously that's something that's going to be key to keep an eye on going forward. If you are a subcontractor, you can choose to register with the revenue for CIS. If you do, you only suffer 20% tax withheld rather than the standard rate of 30%. And if you're a registered subcontractor with turnover over 30,000 and a good record of tax compliance, this is paying tax on time, no late returns, then you can receive your payments gross. So obviously the system is designed to encourage subcontractors to register for tax properly and to have good compliance with it as well. As a subcontractor, you need to make sure you give the contractor sufficient information they can verify your payment status. So in the construction that you might have different trading names to your actual entity name, so it's making sure you're giving the contractor the correct name to verify, and you should be given and retain any payment slip so you can evidence what the deduction of tax has been. In terms of the payments that CIS applies to, this is anything paid by the contractors to the subcontractor under the contract. So it pretty much covers everything that's paid, whether it's paid directly or not, whether it's in cash, whether it's cheque, whether it's credit, if it's made as an advance, a sub or a loan. There are also payments under the CIS scheme as well. However, deductions don't need to be applied to any part of the payment that's for the cost of materials or VAT. So if you're a subcontractor and you spend £10,000 on putting in a heating system, saying you charge £12,000 for installing that heating system, you're only going to get the deduction on the £2,000 effectively. which seems fair. However, this is something, again, that is being looked at as the consultation, where you have a supply chain and materials might be bought at the bottom of the chain and then recharged on. There's a discussion as to how those should be treated and whether those should be deducted as well. So that's something that's potentially likely to change going forward. In terms of the construction operations, switch slides, Andy. Generally, and I won't go in depth into this because Andy's going to cover it a bit later as well. So it's broadly sort of trying to define what construction operations are. It's broadly almost any work that's done to a building or civil engineering site in the UK. So there's a list of specific things that are included. So it's site preparation, alterations, dismantling, constructions, but also repairs and decorating, demolition as well. Specifically not things that might be being supplied to a construction site, but if they're ancillary to the construction operations, so this is your canteens, your hostels, your site security, health and safety, those aren't within CIS. They're not construction operations themselves, even though they're related to the construction site. Specifically not architects, installations of artistic work. So if you're installing large sculptures, that's not a construction operation. Drilling for gas, extraction of minerals, again, it's not a construction operation. And manufacture of components and delivery is not a construction operation. But what you have to watch on this one is if there's any element of installation. So where you've got mixed supplies of construction and non-construction services, that's treated as if it's all construction services. So the revenues example of this is if you have a joiner constructing a staircase off site and then installing it on site, then that will all be construction services, even if the charge for installation is only a sort of relatively minor element of that overall charge. So again, it's sort of watching how you're supplying things if you're in that end of the supply chain. There's quite a lot of good resources available in terms of trying to look at what are construction operations. So the revenues booklet, the CIS 340 booklet's got a good couple of appendices that go into what they think construction operations are. And then in the CIS manual, the link that I put there is an A to Z list of different activities and whether they form to be construction operations or not. And then the final link is just a link to the verification services, so, which obviously you'll need if you're a contractor. And I think I'll hand it back to Andy.
Apologies for messing about the slides there.
I'll let you off.
Work out how this Zoom works. So yeah, just moving back into the sort of VAT side of things then. So I think some key considerations as we go through this and some of the things we touched on when we did the sessions last year as well. So I suppose from our firm perspective and talking to clients and contacts around this, some of the key concerns really are affected around cash flow and systems and how to deal with this going forward. And we can touch on those as we go through this, but just wanted to set out some things to be having to think about as we go through. People may not have dealt with reverse charges in their system historically, so there's new things that maybe need to be considered there. And certainly from a cash flow impact, the fact that suppliers won't be charging the VAT and it'll be shifting the liability of the accounting for VAT does have quite a significant cash flow impact, which we'll come on to as well, that may need some careful management. I think training for staff is going to be important, particularly in terms of understanding what's in and what's out, the use of invoices, how things flow through the system as well. And I suppose just the customer and supplier awareness piece. We had quite a lot of questions and follow-up discussions last year with clients around how to pick this up with the supply chain. And I suppose the earlier those conversations I had to understand what status people are within the chain and whether the reverse charge is going to apply or not is going to be really important for ensuring this can move forward. So yeah, just some things to be having a think about really. So then just in terms of the basic principles, so under normal rules, I'm a supplier of construction and building services today. I'd issue an invoice to my customer and I'd charge VAT where appropriate. Effectively what this does is that it's a tax shift. So it shifts the liability up the chain. So as opposed to the supplier having the responsibility to account for any output tax due, that passes to the customer. So the customer would account for the VAT due to HMRC under the reverse charge mechanism. Now the customer would also be able to recover that VAT if it was allowed to, subject to the normal rules. And then this continues passing along the chain from subcontractors to contractors until we get to something called end users and intermediaries, which I'll touch on shortly. So there you can see where the cash flow impact comes in from that initial supplier, that initial subcontractor. For example, they may be on quarterly VAT returns, they raise an invoice plus VAT today, their customer pays them. They may get 3 months where they can hold on to that VAT and help them sort of manage their business, whereas they won't benefit from that position now, which could cause some issues in terms of how it's managed going forward. It only applies to building construction services, quite obviously, I suppose, anything that's either subject to VAT 20% or the reduced rate of VAT 5%. You can ignore zero rated services for the purposes of the reverse charge, so there'd be just no impact on this. So if a supplier charges zero VAT now, it continues to do so. The other condition as well, it has to be reported under the CIS. So if it's not, it won't be covered. An important difference here between the VAT and the CIS position, and Zoe, correct me if I'm wrong on this, but the VAT reverse charge applies to the whole supply. So CIS payments are only to net status subcontractors. No deductions in the CIS are made on the materials content, whereas for the VAT purposes on the domestic reverse charge, it would be the whole value of the net value of the invoice effectively that's been supplied to the customer. So I think that's quite a key differential. Some of the excluded services. So what HMRC have done, and actually we can send a link round to this guidance afterwards. In fairness to HMRC, it's one of their better notices that explains the detail on this, and it runs through the sort of requirements and some of the mechanics of this in quite a lot of detail. The notice includes services that are included, services that are excluded, but one of the key exclusions is where supplies are made to end users or intermediaries connected with end users, and we'll explain what they are later on. But effectively, an end user is someone that then doesn't make an onward supply in the chain, so would be the user of that property ultimately. But those end users and intermediaries could still be registerable under the CIS. So it'll be really important for suppliers to understand when they're supplying end users. One of the changes in the guidance since we did the sessions last year that HMRC have clarified is that effectively it's the supplier's responsibility for getting this right and determining when the suppliers are subject to the reverse charge or not. There is now a requirement for end users and intermediaries to confirm their status back up the chain, so they'd have to do that. So I think that helps suppliers, but it's obviously everyone still needs to have an understanding of who the end users potentially are and how that impacts on the supply chain. So that's the basic principle. Hope that makes sense. In terms of, again, from an HMRC perspective, they've published this flowchart, which essentially just allows you to walk through when suppliers are covered and aren't covered. And I suppose there's 4 key principles here that everyone just needs to be aware of. Both parties in the transaction need to be registered for VAT, or else the domestic reverse charge wouldn't apply. The suppliers need to be subject to VAT at the standard or reduced rate. Zero rated suppliers are ignored for these purposes, and exempt as well, but probably won't come up as much. Reportable wholly or partly under the CIS, taking on board the materials point from just a second ago, and obviously can't be a supply to an end user. So an end users wouldn't account for the reverse charge. The suppliers would still charge them VAT to end users and intermediaries as they would do ordinarily. So I suppose the key considerations there is, depending on where you are in the supply chain, understanding what your supplier and customer position is going to look like going forwards, and whether your supplies fall in or out of scope of this. So this is a direct lift from HMRC notice, so I won't go through these in detail, but you can see there's quite a lot of content in here in terms of what's included and excluded for the purposes of these supplies, which just gives you an idea. Quite appreciate the point that a lot of our clients might have both, and they might have contracts with customers that cover both the inclusions and the exclusions, and we'll come on to in a second what you do in that scenario. But again, just a couple of different things to be thinking about. But certainly having an awareness of how your supplies fit into this guidance is going to be really key between now on the 1st of March, and also what you're receiving as well, just to understand how relevant this is. But it should be fairly easy based on this to work out where you sit within the inclusion or exclusions. So in terms of just a bit more detail on the end user and intermediary suppliers, so as I've said, reverse charge doesn't apply to the end user position, and effectively the definition of an end user from HMRC's perspective and the legislation is that it's a business or group that doesn't make an onward supply of the building in question or of construction services in question, and effectively could be someone that's actually using the building at the end. Like I said, they could still be CIS registered, so we just need to be careful there. Suppliers that, you know, they may assume that because the CIS registered, they still charge VAT or apply the reverse charge, I should say. But actually, because they're an end user, they just default to the current position, normal rules as of today, and charge VAT and don't apply the reverse charge. Intermediary suppliers as well is those businesses or organisations that are linked with end users. So effectively, it's sharing a relevant interest in the same land in question for those supplies, or being part of the same corporate group, which is defined in the Companies Act. So again, some quite clear definitions of when you would be an end user or an intermediary supplier. And again, they would need to confirm their status back to the supplier as part of this new guidance that HMRC have confirmed. So no impact on end users. You would still charge VAT and not apply the reverse charge to these organisations in the supply chain. So some of the VAT impacts just to cover off. So HMRC have announced a soft landing period from the first 6 months from the 1st of March. So what this is basically saying is that they appreciate this is quite a complex and difficult change for the sector. So they're not going to scrutinise it too much in those first 6 months. So me and Zoe were having this conversation yesterday. So let's say a supplier charged VAT where it shouldn't have done, and customer received that invoice and recovered the VAT as normal. What should have happened is the supplier didn't charge VAT, customer accounts for the output tax and recovers it as normal. You can see in both of those scenarios, HMRC is still in exactly the same net position as long as the supplier doesn't go bump and disappear with the output tax. So that's what they sort of mean by soft landing periods. As long as there's no, you know, tax loss in the period, they're going to give people time to get their systems and processes in place. So we would expect that things may fall between the gaps. But hopefully then clients and businesses have got a period to make sure that they get this right. I would also hope in the current climate with COVID and everything else, the VAT deferral coming, you know, payments due in March as well. Businesses have got a lot to think about, whatever else comes out of the budget. Nobody mentioned Brexit. Lots of things out there that people need to consider, not just this. So, you know, I'd hope that HMRC sort of honour that 6 month landing period. One of the main recommendations we've had with our clients is, and some actually switched over to monthly returns in advance of the switchover last time, which was quite unhelpful. Sort of going back to my point around clients spending money, investing time in making the changes. Monthly VAT returns may be an option because it would speed up the recovery position for those traders and businesses that become a repayment trader with HMRC as a result of this. So that subcontractor who's no longer charging an output tax is likely to have VAT it can recover on its purchases, which will make it a repayment trader. You're going to want to get that VAT back as quick as you can, I suppose, to offset against some of the cash flow impacts of not collecting the output tax and holding on to that for a period of time. So monthly VAT returns is probably a good option to look at. As I mentioned earlier, you're probably likely to have services with reverse charge and non-reverse charge elements as part of that included and excluded list we looked at earlier. What HMRC is saying around that, and there's a bit of a sort of discretion from their side, is that where you have services on an invoice and also non-reverse charge elements, you can just reverse charge the whole lot, which should make it a little bit easier rather than having to split treatments on invoices. HMRC also say that if there's any doubt around whether there's you're on the included or excluded list, your safe bet is to say apply the domestic reverse charge treatment as opposed to continuing to charge output tax. That would be the sort of default position if there was any uncertainty around sort of the VAT position as a result, or whether your supplies were included or not. Some of you may be on some of the accounting simplification schemes that are in place for VAT, such as cash accounting and the flat rate scheme. In terms of cash accounting, you can't actually use this, but if you work the logic through, the suppliers aren't going to be charging VAT anyway. So you start questioning whether there's a wider benefit of the cash accounting scheme. For other supplies, I suppose it's on a case-by-case basis with clients looking at their cash flow and what schemes may or may not be appropriate. The flat rate scheme, again, may be used by clients, may not be, essentially for traders up to about circa 150k. What it allows them to do is just charge a flat rate on their turnover, as opposed to accounting for VAT at 20% and recovering VAT as well. So flat rate scheme traders don't recover the VAT, they just pay a flat rate over to HMRC. Obviously, in the supplier example here, not charging VAT, you probably would question why you would want to be on the flat rate scheme, because you'd probably lose the impact of being on that. And equally for customers in the supply chain, you'd have to account for the VAT under the flat rate scheme, but then wouldn't be allowed to recover it under the opposite side of the reverse charge in terms of the VAT recovery. So you would potentially be at a disadvantage again from being on a flat rate. So again, leading up to the 1st of March, you would probably want to analyse whether either suppliers or customers in the chain should be on the flat rate scheme, and the answer is probably not. I'll come on to some of the issues around tax points in a second, but I suppose some of the main risks for suppliers and customers around this end user point. So Zoe and I will probably can't stress enough the sort of getting awareness with the supply chain as soon as possible, and making sure that you've done your necessary checks to understand who your customers and suppliers are, so that if questioned with HMRC at a compliance review in a future, at a later date, you've got something to be able to support the due diligence you've taken and how you've tried to implement this scheme. But I think probably one of the main risks is going to be around this end user point, and then in terms of how the sort of cash flow has a knock-on effect on businesses as well. So tax points are quite a sort of technical area, I suppose, but typically in the construction sector, for continuous supplies of services anyway, tax points are usually driven by the earlier of the receipt of payment or the issue of an invoice, so whichever is earlier. For building construction on single payment contracts, the tax point is the date the service is performed or completed, unless you raise an invoice or receive a payment before that date. So there's quite clearly will be a transitional issue around the 1st of March next year, where tax points could effectively sit before the 1st of March or after, depending on how you sort of manage the position with your customers, essentially. So HMRC have issued some transitional rules, and it's quite basic actually in terms of that 1st of March date, but the principle would be that if you had a tax point that was prior to the 1st of March 2020 on a particular construction contract, you'd charge VAT, and it wouldn't fall within the scope of the reverse charge. If your tax point falls after the 1st of March, that's when you're in the realm of the reverse charge going forward. So again, that would just need a little bit of careful managing, and particularly with contracts that have started and payments are being received across those that then enter into the sort of new period at 1st of March onwards, if that makes sense. So a little bit of careful planning around invoices that are spanning the date. Again, what we propose to do around that is, as Zoe said, run some sessions closest to the time to look at some specific works examples and some specific contracts and how you could potentially manage those tax points issues. But again, as I said, 6 months soft landing period, so you have got a bit of time to get this right in terms of how it would all flow through. In addition to the tax point rules as well, there's some different rules for I can't say this word, but you can read it on the slide. Can you say it, Zoe? I can't say that word.
Authenticate.
As Zoe said, tax receipts or self-billed invoices. HMRC have announced some slightly different rules for how that will work, so, as you can see on the slide there. I won't go through those, but essentially just to have an awareness that there is some payments possibly made after the 1st of March that would still fall within the normal VAT rules, depending on how that was all structured. So again, as you can see, there's some complexities in the guidance and the structure of this from a VAT point of view that just needs some careful planning, I think. So just a little bit around VAT accounting and the process. So obviously from a sales perspective, sales under the domestic reverse charge when you're a supplier, there'd be no output tax entry in box 1 of your VAT return, but the net value of your supplies would still be reported in box 6 as normal. So this is where the repayment traders will probably arise with HMRC, because whilst you'll have no outputs in box 1, you're likely to have some input tax to recover on an ongoing basis in box 4, which means you'll be in a repayment position with HMRC. So to get that back as quickly as possible, monthly VAT returns, and that might help manage some of the cash flow impacts of this. There is an interesting question at the moment about when do you switch over to monthly VAT returns, and I suppose we can have a debate about this probably separately depending on client, but I know some clients that switched over to monthlies last time in preparation for this, and then HMRC delayed it again. So I suppose there's a balance between getting this in place with monthly VAT returns, but also being mindful that if you do it too early, HMRC could flip the switch back and you have to then reverse everything out with HMRC. And also if you're doing it too early and you currently have an output tax bill, if you switch to monthly returns in, let's say, December, you're then going to be paying probably quicker than you ordinarily would do in the lead up to the change. So just something to bear in mind there around the timescales and when you flip the switch on the monthlies. From a customer perspective, in terms of the purchases, under the reverse charge, so you would enter. So the way the reverse charge works is that those that have done this in the past with international suppliers, let's say, the output tax that the supplier should have accounted for, you account for under box 1, but the net value doesn't go into box 6 because it's not a sale that you've made. It's just a liability that you have to pay over to HMRC. And then in theory, for those clients that are fully taxable, i.e. can recover all the VAT that's chargeable, you're allowed to recover that output tax in full as input tax in box 4. So in theory, those suppliers go on the same VAT return, so there's no net impact. It should just flow through your VAT return as normal. Yeah, just goes on to say here, obviously made simultaneously on the same VAT return. And I suppose the key with this, one of the key takeaways, I suppose, is linked to the sort of supply chain, customer suppliers management of this and making sure everyone's aware. It's doing some analysis to look at what is the impact on your cash flow position and look at how we can manage that and support you on that. We did have a couple of clients that were interested in doing that kind of exercise last year, but obviously it's been parts. If anyone wants to look at that with us in the next few months, we'd be more than happy to look at that. And essentially what we could do is we could remodel some VAT returns. So today's VAT return based on normal VAT returns, how would that VAT return on your cash position look if those suppliers were subject to the reverse charge? So it might be quite interesting to look at that. So in terms of the invoicing position, again, even if you were in the reverse charge scope, you still raise a valid VAT invoice. It still has to show all the requirements on there. Still shows the rate of VAT that's applicable to that service. The key difference is that no VAT will be chargeable on that invoice, but you need to make it clear, fundamentally clear, that it's the customer's responsibility to account for the output tax due. The suggestion from HMRC is that there'll be some specific wording that will be added to the invoice, and there's some examples there. I've highlighted one in bold. That's probably the more straightforward one for me. I don't think the legislative references necessarily add anything. I think as long as it's clear that the customer is to pay the VAT on that service, that's enough of coverage for the supplier position. End of the day, whatever the guidance says, I think supplier and customer working in conjunction together just need to be comfortable that it meets the conditions and it is something that's subject to reverse charge. So the more that you're talking about those things together is going to make this process a lot easier. Trying to do this in isolation, then a customer raising lots of questions about the nature of this in March and April next year, it's just going to make it harder to implement going forward. And again, if there is any sort of concerns or questions around the invoicing process, and appreciate some systems may need changes as well if the invoices are being generated from a system perspective, which they likely will be. It's how you sort of put those changes in place as well. For those clients that haven't used a reverse charge before, the accounting system's likely to need another code as well for reverse charge, or else the way the numbers pulled through to the VAT return might not necessarily pick these transactions up. So again, just having an awareness of how that will work. So I suppose just finally, before we take any questions, just a bit of a recap really. So I hope that's given everyone just a bit of an overview of where it's at, what the rules are, and some of the impacts. And obviously 1st of March 2021 is the key date, subject to any further announcements on further deferrals. So key takeaways, reviewing the nature of your services in terms of what's in and what's out, having that dialogue with customers and suppliers, depending on where you are in the chain. And end users and intermediaries identifying themselves as such, but also people further down the supply chain getting involved and pushing them if there's any uncertainty around that. And then I suppose the key takeaway as well, cash flow and system impacts between now and March, how you're going to prepare for that, how can we help that, and just looking at what the best position is for you going forward if you utilise any of the VAT reliefs that are currently on offer, which may not be beneficial for you going forward given these changes. And as Zoe said, we'll get another session arranged back end of this year, early part of next year, just to run through some more specific examples. Appreciate that's quite a quick run through, and there's a lot of detail that sits behind it, but more than happy for you to give me a ring. Just drop me a line if you want to have a chat through anything in more detail. Thanks all.
I'm just looking at the Q&As. At the moment, we've got no questions. So if anybody wants to, I'll give you a couple of minutes to see if there are any. And if not, if it's a lot of information to take in, hopefully it does summarise some of the key steps that you need to take over the next few months, really, to get prepared. And as Andy says, BHP happy to assist with any questions and specific examples that you've got. Oh, I've got a few questions coming through. Will the slides be available? Yes, I think we'll be circulating those afterwards. Andy, one for you. What classifies as onward supplies for the end user?
So I suppose the end user wouldn't be supplying construction services to anybody else. So the end user would effectively be using the building. Is probably the best way to describe it. So subcontractors and contractors in the chain up to the main contractor will always be supplying construction services onwards through the chain. The end user won't be.
Okay. Yeah, it doesn't look to be renewed. So yes, we will make sure we circulate a link to the recording and the slides, which there's a lot of questions for those. And I think if Andy send a link to the revenue guidance and notice as well to give people. Well,
we can pull a note together with links to our slides, the revenue guidance, and anything else we think is useful.
Okay. I don't think we've got any more questions coming, but what there will be afterwards, I think Nick, who's in charge of the technology that's making its way, I think as you sign off the webinar, hopefully a survey will pop up for you to fill in. It gives you the opportunity, I think, to ask, give us some feedback as to what your thoughts on the presentation, but also I think you can type in any comments as well. So yeah, if when you click off, hopefully that survey will come up, and please ask anything else you want to there, and we will send you all, keep all your, if you're happy to, we'll keep your emails on our files, and we'll send you a notice when we come to do the next webinar as well, so you've got that update session as well. Okay, I think that's it. So thank you everybody, thank you for tuning in, and yeah, we'll keep you posted as things develop.
Brilliant. Thanks all. Have a good day.